Hello everyone, welcome back to our channel. Today we are diving deep into the a major history of the Reserve Bank of India. So hit that subscribe button and let's get started. So basically the story behind it early 20th century when India was experiencing significant economic changes to oversee and regulate the country monetary and banking system. The Reserve Bank of India was established on 1st of April 1935 under the Reserve Bank of Indian Act 1934. The Reserve Bank central office was initially located in the bustling city of Calcutta. It served as a nerve center where policies were formulated and the government presided over circular financial decisions. However, the recognized Mumbai emerging prominence as a financial hub, the central office was permanently moved there in 1935. The shift of Mumbai solidified its position as a financial capital of India. But the day the Reserve Bank was privately owned, but everything changed in year 1949 when the government of India took a bold step and decided to nationalize the RBI. Through this move, the Reserve Bank became fully owned by the government. This was a significant milestone as it ensured the central bank independence and eliminate any potential conflicts of interest. So basically today the Reserve Bank of India stands tall as the guardian of the Indian monetary stability and financial system. Its policies and decisions impact millions of lives and contribute to the country's economic growth. The preamble of the Reserve Bank of India outlines the core functions and objectives that govern the central bank operation. Firstly, the RBI is responsible for regulating the issue of banknotes and maintaining reserve by controlling the issuance of currency and managing reserve. The central bank aims to ensure monetary stability in Indian financial system, which is essential for maintaining confidence in the country's currency and overall economic well-being. Secondly, the RBI operates the currency and credit system of the country with the goal of maximize its advantages. This involves providing sufficient credit to stimulate economic growth and ensuring that the financial system remains stable and efficient. Striking a balance between providing credit for growth and maintaining financial stability is crucial to fostering sustainable economic development. Thirdly, recognize the complexity of the modern economy. The RBI seeks to establish a modern and sophisticated monetary policy framework. This framework is designed to address the challenges posed by an increasing dynamic and interconnected economic landscape. By adopting adaptive policies and tools, the central bank efficiently responds to changing economic conditions and steer the country towards sustainable growth. Finally, the Reserve Bank of India is committed to maintaining price stability while keeping in mind the objective of growth. Controlling inflation and keeping prices relatively steady as essential to ensure that the purchasing power of the currency remains stable, that the cost of living of the citizen is manageable. However, the central bank also acknowledged the importance of promoting economic growth for the overall prosperity of the nation. The structure of RBI is defined by its Central Board of Directors, which act as the supreme governing body, appointed by the Government of India in accordance with the provision of the RBI Act. The Central Board play a crucial role in overseeing and maintaining the affairs of the RBI. The Central Board is composed of various members, including government officials and individuals from the financial and banking sector. The governor of the RBI is also the part of the Central Board. The appointment or nomination to the Central Board are made for a fixed term of 4 years, allowing continuity and stability in decision-making process. To ensure efficient transaction and focus attention on the specific areas, the Central Board may establish subcommittees. These subcommittees are responsible for handling specific tasks and responsibilities and providing valuable insight to the Central Board. In addition to the Central Board, the RBI has regional boards located in different parts of the country. These regional boards represent the interests of their respective region and provide regional economic perspectives to the Central Board. The Reserve Bank of India constitutes Central Board of Directors consisting of official and non-official directors. So let's take a closer look at each component. So the official director, that is Central Board of Directors, include full-time officials, primarily the governor and not more than deputy governor. The governor is the head of the RBI, play an important role in formulating and implementing monetary policy. As of the current time, Sri Shaktikant Das holds the position of the governor. Non-official director. So basically this category comprises directors who are not part of the RBI full-time leadership. Among the non-official directors, 10 are nominated by the Government of India from various fields, bringing diverse expertise and perspectives to the board decision and decision making. Additionally, 2 government officials also serve as a non-official directors on the central board. The Reserve Bank of India performs a diverse range of functions that are crucial for maintaining the stability and development of the Indian financial system. So now explore the main functions of the RBI. The first one is monetary authority. The RBI is the Indian Monetary Authority and is responsible for implementing and monitoring the country's monetary policy. It aims to ensure price stability while considering the objective of the substantial economic growth. So basically in 2016, the RBI introduced the Monetary Policy Committee to bring transparency and accountability to the decision-making process regarding monetary policy. So basically the Monetary Policy Committee determines the policy interest rate required to achieve the inflation target which is set by the Government of India. Second one is regulator and supervisor of the financial system. So basically the RBI prescribes the board parameters within which the country banking and financial system operates. It issues license, regulates branch expansion and sets liquidity norm for banks. The RBI's objective is to maintain public confidence in the financial system, protect depositor interest and provide cost-efficient banking service to the public. The third one is manager of foreign exchange. The RBI manage Indian foreign exchange reserve and facilitate external trade and payment. It promotes the orderly development and maintenance of the foreign exchange market in the country while also maintaining the external value of the Indian rupee. The fourth one is issuer of the currency. As the sole issuer of the currency in India, the RBI is responsible for issuing and exchanging currency notes and coins. It ensures an adequate and good quality supply of currency to the public. The fifth one is development role, in which the RBI perform various promotional functions to support nation objectives, such as making institutional arrangement for rural and agriculture finance. It also directs commercial bank to provide loan to small scale industry units in line with the priority sector lending directives. The sixth one is financial inclusion, in which the RBI has adopted a bank lead model for financial inclusion in India. It has undertaken policy measures such as introduction of non-frills accounts with low minimum balance and charges, as well as the use of technologies like ATM, mobile banking and internet banking to provide banking service to all sections of the society. The seventh one is related functions. So as the banker to the government, the RBI handles merchant banking functions for the central and state government. It manages the government money, remittance, exchange and public debt. Additionally, the RBI acts as a banker to the bank, maintaining accounts of all scheduled banks and serving as a lender of the last resort by providing funds to the bank when needed. So basically, the Reserve Bank of India administer several important acts that are instrumental in regulating various aspects of the Indian financial system. Here are the acts administered by the RBI. The first one is Reserve Bank of Indian Act 1934. So basically, it is the primary act that establishes and governs the functioning of the Reserve Bank of India. It outlines the powers, function and duties of the central bank. The second one is Public Debt Act 1994 or Government Securities Act 2006. So, this act governs the issuance, management and redemption of the government securities in India. It provides legal framework for managing country public debt. The third one is Government Securities Regulation 2007. So basically these regulations provide detailed guidelines and procedure for issuance, trading and settlement of the government securities in the financial market. The fourth one is Banking Regulation Act 1949. So this act is the foundation for the regulation and supervision of the banking sector in India. It empowers the RBI to regulate and oversees the functioning of the banks in the country. The fifth is Foreign Exchange Management Act 1999, mostly known as FEMA. So FEMA is a crucial act that consolidates and amends laws related to foreign exchange, facilitating foreign trade and payment, and regulating foreign exchange transactions. The next one is securitization and reconstruction of the financial assets and enforcement of the Security Interest Act 2002. So basically, this act empowers the RBI to regulate and supervise securitization and asset reconstruction companies that deal with the acquisition and reconstruction of the financial asset. The Credit Information Companies Regulation Act 2005. So, this act governs the regulation and functioning of the credit information companies in India. It facilitates the collection and sharing of credit information to assess creditworthiness. The next one is Payment and Settlement System Act 2007. So this act provides the legal framework for the regulation and supervision of payment and settlement system in India. It ensures the safety and efficiency of electronic payment and system. And the last one is Factoring Regulation Act 2011. So this act regulates and promotes the factoring business in India, facilitating the financing of reversibles of the suppliers by factoring companies. Now, the Reserve Bank of India has undertaken several initiatives to promote financial inclusion, innovation, and facilitate international trade. So now let's explore some of the recent initiatives taken by the RBI. So the first one is Reserve Bank Innovation Hub. So in a recent move to foster innovation in the financial sector, the RBI governor inaugurated the Reserve Bank Innovation Hub in Bangalore, established as Section 8 company under the Companies Act 2013. So basically, the Reserve Bank Innovation Hub aims to create ecosystem that promotes access to the financial service and product, particularly targeting the low-income population in the country. As wholly owned subsidiary of the RBI, the Reserve Bank Innovation Hub is set to derive research and development efforts, encouraging technological advancement in financial sector to benefit all the segment of the society. The next one is facilitating international trade in rupee. So basically to an exchange cross-border trade transaction and promote the use of Indian rupee, that is in INR, in international trade. The RBI has implemented a mechanism under the Foreign Exchange Management Act 1999 to be denominated and invoiced in rupees. Additionally, the exchange rate between the currency of two trading partner countries can be market determined, offering great flexibility and ease of transaction for international trade. The RBI functions with degree of independence but not entirely autonomous. The Reserve Bank of India operates with a central level of independence in its decision making and policy implementation. However, it is not entirely autonomous, as certain legal provisions allow the central government to issue direction to the RBI. So, as per the Section 7 of the RBI Act, the central government has authority to give direction to the RBI in public interest. These directions may cover various aspects of the central bank operations and policy. The next one is the RBI has historically been seen as an autonomous institution with authority over all commercial banks in the country. It acts the central bank authority and regulator, overseeing public sector banks, private banks and foreign banks. The third one is the RBI play a crucial role in formulating and implementing the country's monetary policy. It set key interest rate, manage liquidity and aims to achieve the objective of the price stability and economic growth. Additionally, the RBI monitors the functioning of all the banks to ensure compliances with regulation and maintain financial stability. The fourth one is to effectively fulfill its responsibility. So basically, the RBI requires a certain level of autonomy in its functioning. This independence allows the central bank to make impartial and objective decisions in monetary policy and banking supervision. Over a time, there has been an instance where RBI independence has been challenged due to the conflicts and power struggles between the central bank and the government. Such challenges can impact the central bank ability to operate autonomously and raise concern about the effectiveness in carrying out its function. The RBI has faced challenges in maintaining its independence due to the several reasons. The first one is the RBI has criticized for not efficiently controlling the growth of non-performing asset in the banking system, which has led to the financial instability and affect the credibility of the central bank. The second one is the RBI implementation of tight monetary policy to control inflation and stabilize the economy has resulted in reduced liquidity, affect credit availability and economic growth. The third one is the correction measures taken by the RBI to clean up the bank system, such as initiating strict asset quality reviews and forcing banks to recognize bad loans, have faced resistance and criticism from the government. The fourth one is there has been a clash between the government short-term populist agenda aimed at immediate benefits and RBI's focus on maintaining price stability and long-term economic growth. The fifth one is the RBI regulatory powers over public sector banks are limited by statute, hindering its ability to take robust action like asset management, replacement, or license and revocation, which can be applied to private bank. The last one is Price B legislative amendments has eroded the RBI statutory power, impacting its autonomy and ability to act independently from the government. So I hope you enjoy this journey, and until next time, keep learning and explore the fantastic world of bank. Thank you.